Hello, everybody. Welcome to our quarterly market update, our third quarter of 2025. It's been an interesting year in the markets, but Mike, before we start, how was your fall break last week? As we're recording this here on October 16th.
Hey, Kevin. It was great. I got to watch my middle son, Luke, play his last golf tournament ever. So certainly lots of feelings about that, but it was good. Great weather. And yeah, just I love fall. Fall in Middle Tennessee is almost as good as it gets weather-wise. So you guys have had a lot going on recently. How you been?
Gosh, yes, that is a understatement. We had our second child, Wells Underwood, on September 29th. So we've been everyone is good and healthy and at home, which is awesome, and adapting to our new normal, which will continue to evolve as kids get older. But yeah, it's been super exciting and an answered prayer to welcome Wells to the world.
I love it. I'm the guy that tells other dads who have kids much younger than mine how fast it goes. So enjoy every moment of it.
Amen. Having a 4-year-old, I'm remembering how fast it all went. I appreciate that. Well, let's dive in here, Michael. Been a lot going on in the market in general. Did want to just start with the rate cut that happened in September, and there's a quote that I think is over 50 years old that says don't fight the Fed. So would love for you to maybe elaborate on that and kind of what your thoughts are on for the rest of the year as well too.
Yeah, don't fight the Fed is certainly something that that quote's older than I am for sure, by a few years, but it's something we've heard a lot in this industry. And the best way to think about the Fed, obviously, is many of you know this, is they're just there to preserve stability. This chart is kind of a fascinating chart because it goes back 70 years. And so Fed rate history, we could have a whole series of market updates on just Fed rate increases and decreases in the history and the reasons why. You see a huge spike there in the 80s when I believe Paul Volcker was the Fed chairman back then and had to really do some creative things to get the economic system back under control. But the Fed is really just there to control the money supply, keep things stable so that investing can really happen. That's kind of the way that I look at it, is so that money can flow properly, whether it's investments in business, transactions with consumers, obviously, just looking for peace and prosperity. That's what the Fed is trying to do. The market currently is predicting probably 2 more rate cuts. The Fed will meet later in October, later this month, and again in December. So we'll see. But it's certainly been interesting to see the market react. Part of the market's reaction this year, it's been an interesting year, but part of the market's reaction this year has been to Fed rate cuts for sure.
Yeah, absolutely. It's been interesting to see the predictions change as they have. But as you said, 2 more are currently priced in, and we'll continue to keep an eye on that. So let's kind of talk about what's happened so far. We always talk about volatility. So this year is actually very normal. Even though the numbers are big, but in late April, if you look at large cap here, which we were down 15% at day, I think, when the day closed, and you wake up today and we're up 15. So quick math would just show it's been a 30% swing alone in the large cap this year. But yeah, Michael, what would you just say about what we've experienced this year from a market rebound, not only in large cap but other sectors like international or small cap or bonds?
Yeah, if our clients or anyone listening wants to kind of think about or wonders kind of what we think about as advisors and what we pay attention to in the market, we pay a lot of attention to asset classes. And why would that be true? Well, let's just kind of look at a couple examples. Like you said, Kevin, large cap stocks were basically down 15 through early April, up 30 since then. The dividend or value side of that market was really only down about 10, and then it's up 20 since then, roughly. I'm going to kind of round some of these numbers. The growth side was down 20, and since then is up almost 40. So that starts to tell you if the large cap growth market is up 40% over the last roughly 6 months, then that tells you that the market has still a pretty high appetite for risk. Now that's important as you start to make asset allocation decisions in the management of portfolios. Now, for our existing clients, that's what you have us for. Um, let's look at international. It was down actually only about 3.5%, and then since then it's up almost 30% as well. And so it's important to now some of the international stock is highly U.S. investors' return is highly influenced by the value of the dollar relative to other currencies, but international stocks in that way kind of act as a dual hedge, both from an asset allocation standpoint, so that you don't have all your eggs in the same basket in your portfolio, but also as a currency hedge. Small cap, very interestingly enough, was down 21% to the first almost 3.5 months of the year. And as we sit this year is only up about 3% this year, which is even bonds have outpaced small cap stocks. Bonds, interestingly enough, were up about 1% through the volatile times of this year, which is, again, important to remember. When the money leaves the stock market, it generally is going into the bond market, which holds the bond market together with the money influx a lot of times. And bonds on average are up about 3.5% so far this year. So bonds are kind of acting more normal, the way they're supposed to be, the way they act most of the time. And so it's been kind of a fascinating year to look at. But I think, as advisors, what we're looking at is different asset classes, because we're trying to understand what is the market's general appetite for risk. And as you know, Kevin, that general appetite for risk is still pretty high. And so I think that'll make sense as to how we kind of apply that here in the next couple charts.
Yeah, absolutely. Definitely agree there. One thing that's been really popular in the media and in the news, and that we hear a lot about is, prices are high and valuations of companies are really high. So I wanted to just demonstrate through this chart, Michael, if you want to elaborate on what we're seeing and historically how things are priced versus maybe in the past through things like 08 or even before.
Yeah. This is a chart that we look at a lot, yet we don't show it a lot. But I think viewers of this, of these market updates will see this chart more often. It essentially shows what's called a forward price earnings ratio. So some of you know what this is, but a forward price earnings ratio is just takes the price of the stock divided by generally the next 12 months of forecasted earnings. So the PE ratio, you can have a backward looking, you can have a forward looking. It's almost a measure of if you do the grocery shopping for yourself or for your family, you would know if the price of a loaf of bread or a gallon of milk, whatever, is high or low. You'd kind of have a general feel for that. This is kind of a technical way to it's not the only way, but it's a technical way to kind of judge the price of stocks, whether or not they're high or low. You can see from this chart in the late 90s, we got up generally to about a mid-20s price to earnings ratio. That just means that if a stock had $1 of projected earnings per share over the next 12 months, it would trade at about $24 per share. Just fairly simple math. You can see in early 09, it got all the way down at the bottom of the crash. This would have been March 09 to less than $10 price earnings ratio. And today, fast forward to September, most of this data is as of the end of September, the end of the calendar quarter, we were back up to kind of a low 20s, 22, 23 price earnings ratio, which is somewhat alarming, I would say. I would say that I've been waiting most of my 20-year career to get back to the point where price earnings ratios were in the low to mid 20s. And we're here now. We briefly hit that in 2020, but there was a lot of volatility and other stuff going on that we talked about in market updates during that time. I wouldn't say we're significantly alarmed. We'll talk about it again here in a second on another slide, but it is just kind of fascinating. And this is not it's not the end all be all of statistics, Kevin, but it is one thing that we're looking at in terms of kind of whether the stock market is fairly priced or underpriced or overpriced. The 30-year average is about 17 times price earnings ratio. And so that's just something we're looking at quite a bit right now.
Absolutely. And so I think kind of what's driving that, I'll talk about this in the next slide, is obviously AI, right? AI is what everybody's talking about from an investment standpoint. It's definitely propping up the market currently. But I guess that's kind of the question, is it a bubble? Do we think it's going to continue to drive growth? And so, Michael, what would you say more about that as far as the AI being the next bubble versus maybe where things could go?
Yeah. There's really, it's fascinating. There's really so much that we could say, but a few points here on this chart essentially shows kind of the price earnings ratio of the top 10 companies in the Standard & Poor's 500 index, which is generally just the largest 500 companies in the US, right? The price earnings ratio of the top 10 companies is about 30, and the rest of the S&P 500 or the average is about 23. So the largest companies are really trading at higher prices than the rest of the 500 companies in the S&P 500 index. That's kind of a fascinating phenomenon. Is AI the next .com bubble? That is being talked a lot about in the financial news. It's almost the sentiment that I have is almost like if we're talking about a bubble, then we're probably not in one. I can't remember who told me this years and years ago, but they made kind of the analogy that, like, you're really in a stock market bubble when even like your dentist quits his or her job to go trade stocks. That's not really where we are right now. This next chart will be very revealing, but anytime you're in a place where there's concern and discussion in the financial news media about a bubble, kind of means that you're not really in the bubble yet. Now, we may be in the beginning of the bubble, but the bubble is not really ready to pop until it kind of sucks everyone in like a vacuum, and then it kind of spits everyone out. And so we certainly anticipate here in the next several years being maybe at kind of a higher market high that'll be more concerning. But right now, it just feels, I think, to me, Kevin, like based on the discussions and things that are happening out there, if people are talking about a bubble, that's more representative of like some healthy fear and some healthy concern versus what we worry about a little bit more as something you might call irrational exuberance, where nobody's talking about a bubble anymore, if that makes sense.
Yeah, absolutely. And so, yeah, we've experienced a lot this year. Obviously, the AI is driving a lot of the growth, those top 10 companies. Again, we're up 15%. So when you talk about, just where the market sits today, we've eclipsed new highs if you just look at the S&P 500 this year. And so, it's something that you're concerned about when you hear all-time highs. A lot of times people hear all-time highs and they get nervous. They think that assumes we're going to have a pullback. But obviously, to have new highs, you got to keep surpassing that. So how do you think about this, Michael? And yeah, do you feel concerned with all-time highs, or does it give you kind of excitement, or somewhere in between?
Yeah, that's a great question. I'd probably, to talk out maybe both sides of my mouth, concerned and excited. But here's why. It's not the bus that you see coming that hits you. It's the bus that you don't see coming that actually hits you. And that's important to think about as investors, which is why if we're talking about something in the financial news media, then that may not be the thing that actually gets us. It could be, and probably will be, something that's not being talked about. That was true in the late 90s before the dot-com bubble. Nobody expected 9/11. Right after that, nobody expected the accounting scandal the very next year. I mean, those are the three things that kind of caused that roughly 50% crash in the stock market. Nobody was really worried about subprime mortgages in 2008, which caused a lot of the Great Recession. The thing about this slide that has us probably a little bit more excited than concerned is that new market highs tend to cluster together. Mark Twain says history doesn't repeat itself, but it certainly rhymes. In the late 90s, we had 243 new market highs in the last 5 years of that century or decade of the 90s. 243 new market highs on a closing daily basis, if you were just to use the S&P 500 index. Well, through the first the 4 quarters of last year and the first 3 quarters of this year, the last 7 calendar quarters, we've had 62 market highs, new market highs. And so if history does kind of rhyme or repeat itself, then you can see right there in the middle of that chart, you had 11 years out of 12 years with 0 new market highs. 11 out of 12 years with 0 new market highs. We'll talk about that here in a second. I just think, Kevin, that we're probably going to get, in conjunction with what I was mentioning on the previous chart, you're probably going to get a larger quantity of new market highs clustered together over a several year period before this market kind of goes into a period where we have a longer term kind of sustainable or longer period of poor performance. That's probably the easiest way to say it.
Yeah, that makes sense. Excuse me. Yeah, so it's interesting to see. We'll continue to keep an eye on this. This obviously goes back with our other slides of earnings and volatility and kind of where things sit today. So I would like to kind of zoom out a little bit, Michael, with this slide and just say, okay, obviously we talked about a little bit about what's happened this year. Like always, we kind of like to take a long-term approach with certain things. We obviously want to know what's going on short-term, but let's zoom out a little bit and maybe talk about what's going on with this slide and why we think it's important today for our listeners to hear.
Yeah, this is a great visual that just shows for the last 30 years how much money has each asset class really earned or made, or what has performance been over and above inflation, right? Because in finance class, you kind of learn about a thing called real return. Real return is your total return, how much money you made on a certain investment minus inflation. So you can see that over the last 30 years, small and large cap stocks, $10,000 became $80,000. Now that's over and above inflation, right? If we just took the total return, we're approaching 150. $10,000 would have become $150,000 to $200,000 during that time frame, just a single $10,000 investment. But when you factor in inflation, 10,000 becomes 80,000. So 8 times essentially its original investment, which is a significant, positive outpacing of inflation. What you also note from this slide is that bonds $10,000 became $20,000, so a little bit of outpacing over and above inflation, and then $10,000 in cash became $9,000 roughly, so lagging inflation. I think it's important to remember, just as we zoom out, how we allocate our portfolio. Even though we can't control the markets, we can control how we allocate a portfolio. And this chart just really beautifully, very simply highlights the truth that equities are still your best liquid inflation hedge over the long run. Yet because of volatility, that's obviously why we utilize more conservative asset classes like fixed income and cash over shorter timeframes for shorter, duration financial goals. So it's kind of like we need to kind of keep in mind both things can be true. Cash can be king over the short run, but over the long term, cash is kind of more like trash. And so we would just want to have a really healthy view on using longer-term growth-oriented investments that will outpace inflation for our long-term goals. One of the major risks in investing is inflation and being able to outpace inflation. The other major risk is volatility. And so we have essentially 2 different types of investments, growth and conservative. Growth helps us obviously hedge against inflation. Conservative investments help us hedge against volatility. So they react very differently, and it's just important to always remember that. And this chart articulates the numbers in kind of a new way, being able to see only the growth, that's over and above inflation over the last 30 years.
And Mike, I almost have to laugh because it's funny to see cash going backwards, right? I think what's been cash has been such a hot topic, right? I think we saw our cash earning over almost 5.5% 2 years ago, down to like 4%, and obviously people get excited about that, which understandably, because before that cash was 0 or 2%. But I think to be reminded over the long run, cash is actually losing money. And however, based on your goals, of course, we need to have some amount of cash. But to your point, over the long run, you don't love seeing cash be negative, even though, relatively speaking, recently cash returns have been high. But I think it's just a good reminder of, okay, that won't be forever. And then when you compare it to inflation, whether it was 8 or 9% or maybe even higher, it's been negative, and we think it will continue to be negative over the long run. But again, needing to have enough in a safety net for emergencies or planning purposes.
Yeah, 100%. That's exactly right.
Well, let's. I kind of want to move on to the next slide. Michael, talking about recessions a little bit here and kind of just, again, things are at all-time highs, maybe what we could see happening. But, what is, and right, obviously, the word recession, a lot of things come to mind, but what is concerning to you? We often say here, we're not really worried about bad years, but we're worried about bad decades. Again, bad years, we generally bounce back very quickly historically. 22 to 23 would be a good example. Very quickly, no concern there, but say more about bad decades and maybe what's concerning for you, Michael.
Yeah, I think many listeners can probably kind of read between the lines, but just to kind of be clear so that you don't have to, one of the major concerns that we will have is when is the next bad decade start? And we don't think it's coming in the next year. We obviously, past performance and history is no guarantee of future results. There's no guarantee it's going to repeat itself, but we kind of think we think that it kind of will resemble that. Obviously, like I said a minute ago, we're certainly not worried about the next bad decade, but we are concerned about it. In our view, it's probably still a few to several years off due to some of the data that we just looked at. But yeah, this is a great chart that kind of highlights that. I mean, you had the 1930s post Great Depression, where the market went nowhere. I mean, you had an 8-year period where if you were invested in the Dow back then, the Dow Jones Industrial Index, your investment took about 4 years to go down 80% and 4 years to come back up. Now, what was happening prior to the Great Depression, or prior to the stock market crash, I should say, is you had just ridiculous margin loans, which is when you borrow money to buy stock, essentially. You had ridiculous, almost no margin limits, where you could borrow, let's say, 80% of your stock value to go buy more stock. And those loans were called at some point. And there was a lot of other things that happened during the Great Depression, but just that was a huge part of the stock market crash. And a lot of that was fixed in regulation in basically in the late 30s, early 40s. A lot of that was fixed with just good, healthy stock market regulation. You had another bad decade in the mid from kind of mid 60s to mid 70s, where we faced issues like stagflation that eventually worked themselves out due to a lot of hard work from a lot of smart people. Some in New York, a lot in Washington, D.C. And then the third bad decade of the last century was really the 2000s. As I said several minutes ago, it started out with the dot-com bubble, but then 9/11, which was a whole other separate issue and just a horrendous, obviously, event, very painful event for our country. But from a stock market standpoint, there probably was some impact there. And then you had some accounting scandals in early 2002. So the market kind of got kicked twice while it was already down, which really kicked off the most recent bad decade that we've had. That bad decade ended in 08, early 09, with the worst market decline that any of us have seen in our lifetimes. The S&P 500 bottomed out around 670, and now it's worth about 10 times that. So we certainly have good reason to stay the course for the S&P 500 index to be here 16 and a half years later, to be up 10 times. That doesn't even include the dividend on the S&P 500 index. That's really a lot of, that's a good example, I guess, Kevin, of what I'm trying to say is history repeating itself. We don't get 10% in the S&P 500 index every single year. We don't get anywhere close to that. But it does kind of average that over the long run. But the way it really averages that is kind of through up and down years. The way you'd say it from a decade standpoint to kind of close out today is you get about 0% during the bad decades, and you probably get somewhere close to 15% during the good decades. And so the cycle essentially, Kevin, as you know, is kind of bad decade and then good decade, and then probably another bad one. So it'll be interesting and kind of fascinating to watch how this plays out. For current clients, we're obviously watching the market like a hawk. Nobody can predict it, time it perfectly, as everyone knows. But it is important to make subtle asset allocation and strategic, moves and decisions and changes to preserve and protect the portfolio as much as we can. So,
yeah, absolutely. And I would just say, I think we're again for the rest of the year, we're definitely optimistic. We'll continue to watch all this for you as our clients, as Michael mentioned, and we really appreciate you all. We thank you for letting us serve you. For our non-clients, I just want to say two things. When non-clients generally approach us, they're generally asking two questions. They're really saying, hey, do I have the best possible portfolio, or the highest quality portfolio that I possibly could. Or they're saying, hey, am I positioned right for my goals? And so if you're wondering that as a non-client, we'd be happy to review that. Please feel free to email us at the Purefoy Wealth team at SageSpring.com, and we'd be happy to connect and review anything for you if that would be helpful. So again, thanks for listening. We really do appreciate you all, and we'll be in touch here soon. Thank you very much. Thanks, Michael.
Thanks, everyone. See you, Kevin.